The new Reserve Bank governor keeps rates on hold but warns there might be another hike in the offing. Share markets tumble with miners hit hardest, and the hot weather spurs record solar power generation in the national electricity grid. Welcome to Fear and Greed Business News, Australia's best business podcast. It is Wednesday, the 4th of October, 2023. I'm Michael Thompson, and good morning, Sean Aylmer.
Good morning, Michael.
Sean, you have an interview coming up today with one of our regular guests. Always interesting to hear what Matthew Kidman from Centennial Asset Management has to say.
Matthew, he has a go at me for always asking about banks. Come on, Matt. What's going on? It's a great chat. We talk about what to look. I mean, the market's really been sold down. Yesterday, of course, was one of the worst days in many months. And so we talked to Matthew about exactly how investors should think about it, where the opportunities are. He even mentions a couple of specifics, so definitely worth a listen.
Absolutely. We're not an investing podcast, and we certainly recommend that you get professional advice before making those decisions, but it's always interesting hearing what a professional like Matthew thinks about the state of the market at the moment. Now, the main story this morning, Sean, Reserve Bank Governor Michelle Bullock, in her first outing as governor of the central bank, has left interest rates on hold, but she's warned that at least one more increase might be necessary to stamp out inflation.
Bullock said the decision to keep rates on hold provides time for the bank to assess the impact of the increases in interest rates thus far and the outlook for the economy. While inflation in Australia has peaked, it is still too high and will remain so for some time yet, she said, highlighting the rapid increase in petrol prices since July. Bullock said recent data is consistent with inflation returning to the Reserve Bank's 2 to 3% target range in late 2025. It's a couple of years away. That assumes labour productivity, which has fallen 6.5% since its peak in March last year, starts to grow again. If that doesn't happen, then inflation in the services sector, which is very labour intensive, well, it will remain entrenched at unsustainably high rates as businesses pass on higher wage costs to higher prices, and that would mean higher interest rates.
So how did Michelle Bullock go? Because I know yesterday, Sean, you were saying that everybody would be watching quite closely for any kind of changes in language and all that kind of thing. Was there much change from her predecessor, Philip Lowe?
I wish I could say yes, massive changes, but no, not really. I mean, the post-meeting statement is little changed, and that, in a sense, will satisfy investors and economists. They really want continuity between the former and current governors. It's quite remarkable at the moment how many people are missing Phil Lowe. Not sure they were saying that a few months ago, but, you know, they respect him, and so they would like Michelle Bullock to follow his lead. She, like Lowe, is worried that inflation is still too high and wary that the Reserve Bank has already lifted interest rates 400 basis points. If we put that into numbers, on a $600,000 loan, that's another $1,300 a month in mortgage payments. A lot of money. Bullock is worried that households, or at least some households, are starting to find things a bit tough. The bottom line from yesterday, rates are on hold, but the Reserve Bank has a bias towards tightening at least one more time.
Sean, that's interesting that there wasn't much change at all. And would the fact that Michelle Bullock was the deputy governor mean that there was more of an expectation of consistency?
Yeah, I think so. I mean, there's a continuity. She would have learnt her skills. Well, I mean, she certainly would have been taught well by Phil Lowe. So she comes, cut from the same cloth sort of thing. So it's not really a surprise that she's come out in a fairly similar way. Now,
you alluded to this earlier, Sean, but local markets didn't perform too well yesterday.
It wasn't good. The market closed down 1.3% to 6,943 points. Could have been worse. Initially, yesterday morning, it was off about 1.5%. Now, it followed a sell-off on Wall Street, reflecting higher bond yields. More on that shortly. The market hit its lowest level in 6 months, with the action on Wall Street really overshadowing the Reserve Bank announcement. 10 of the 11 industry groups on the ASX were in the red, with the energy and mining sub-indices both falling more than 2%. Where to start? Energy giants, they didn't do so well. Woodside and Santos both fell close to 4%. Gold digger Newcrest Mining and tech leader WiseTech Global were off 3%. BHP, Goodman, James Hardie, QBE all ended around 2% lower. The banks actually were outperformers because they fell by less than 1%. Woolies, Coles and Telstra also fell by less than the market. In fact, about 85% of companies on the ASX 200 ended lower yesterday. Really, the hardest hit were the miners. In fact, there were only 5 stocks in the top 200 yesterday that managed to gain more than 1%. I mentioned bond markets. So this is all about bond yields. The yield on a 10-year government bond jumped 10 basis points yesterday to nearly 4.6%, its highest point since 2011. That's what you can get when you invest your money risk-free. It's up about half a percentage point in just 2 weeks. Shorter dated bonds, like 3-year bonds, are at 4.14%. Now, these yields are part of the calculation in how equities are valued. The higher the 10-year yield, the more the value of future earnings from a company is discounted. So as yields go up, companies' future earnings are discounted. Therefore, they're worth less, share prices fall. That's kind of the machinations of it. Matthew Kidman goes into this in our interview after the show, and it's really, really interesting. Just quickly, I'll also mention the Aussie dollar. It's trading around 63 US cents. While the Reserve Bank news should really have pushed up the Aussie dollar, the news out of Wall Street was kind of the overwhelming factor and pushed it lower.
So international markets then, Sean, are all about US bonds?
Yeah, totally. Over the past 24 to 36 hours, US Treasury yields have soared. Basically, the rest of the world has gone with them. The benchmark 10-year note in the US is now at its highest point since 2007. Investors in the US had forecast rate cuts in the world's biggest economy, given better than expected economic growth and the rhetoric from the Federal Reserve in the past few weeks. Those same investors now reckon rates will stay higher for longer, pushing up bond yields. Bond yields, in effect, reflect what people think rates will do in the future.
Goodness me. Big 24 hours for bond yields.
Yeah, I didn't think you'd ever say that.
I know, I didn't. Those were, and even the excitement in my voice. But Sean, you've actually made this all sound very, very, very exciting. And the best part, I understood every word you said today.
Oh, come on.
I jest. I got 80%, but that's pretty good.
Yeah, that's pretty good. Yeah, I'm with you.
For me. We'll be back in a moment with the rest of the day's business news. Sean, it is hot in many parts of the country, which you think would not be good for energy consumption and greenhouse gas emissions as people kind of crank up the air conditioners. But, in fact, coal power generation in recent days has hit a new low.
The reason, Michael, is that rooftop solar output has surged with all the hot weather, putting more energy into the grid. It means coal-fired generators haven't been needed to the same extent as normal. In fact, coal power generation in the national electricity market fell to 7,440 megawatts at 2 p.m. on Saturday. Now, that's about 95 megawatts below the previous low. On Sunday, rooftop solar supplied more than 50% of total demand on the national energy market. In Queensland and South Australia, rooftop solar met 99.7% of total electricity demand from 1 p.m. to 1:30 p.m. Now, okay, just 30 minutes, but it's pretty exciting to think that rooftop solar can do what it's done. Obviously good news, much cleaner energy, but it also highlights the economic challenges for coal-fired generators.
And just staying in coal, Sean, the latest government forecasts say that the value of exports will tumble over the next 2 years on the back of much weaker demand.
And of course, that would trigger a drop in income for Australian businesses, but also for the Australian government. The forecasts predict that while volumes will jump, there'll be a near 50% drop in the value of shipments. That means the value of thermal coal will drop from about $66 billion currently to $28 billion in the 12 months to the end of June 2025. Metallurgical coal will drop from $62 billion to $41 billion.
Now, there's been a boardroom battle raging at Endeavour, the liquor company previously owned by Woolworths. The board yesterday backflipped on an earlier decision and will allow former Woolworths executive Bill Wavish to stand for election at the group's annual general meeting later this month.
Now, this battle involves some pretty big names in corporate Australia. Endeavour owns the Dan Murphy's and BWS liquor chains, as well as about 350 hotels. Yesterday, it came out and said it had reversed a decision to not allow Wavish to run for the board after discussions with the ASX. It had run foul of some pretty big names. For example, Bruce Matheson, who owns 15% of Endeavour and whose son, Bruce Jr., sits on the board, wanted Wavish to be allowed to run. After yesterday's announcement, Bill Sr. said Endeavour's chair, Peter Hurl, should be ashamed of his bid to block the vote, and his chairmanship is now untenable. Also backing Wavish is former CEO at Woolies, Roger Corbett. The company told the ASX that it's concerned about the ongoing and significant disruption associated with the spat. That is an understatement.
So much drama.
Oh, goodness, who thought that could happen at the board of a liquor company?
Well, it goes back to the debate that you and I have had about how exciting AGMs are. When I say that I love AGM season, this one sounds like it's gearing up to be a cracker.
Oh, it's going to be exciting. No doubt.
Now, casino group Star Entertainment has put its Treasury Casino complex in Brisbane up for sale, hoping to sell it for more than $200 million.
Yes, it needs some help, Star. It will vacate the 3 sites. That's the Treasury Casino building, the Treasury Hotel and the Treasury Car Park when it moves into its nearby $3.6 billion Queen's Wharf development. Star is part of a consortium developing an entertainment, gaming and leisure precinct. It's been a rough ride for Star, which reported a $2.4 billion annual loss last financial year, thanks to a $2.2 billion write-down in the value of its 3 casinos. In June, Star and co-owner Far East Consortium sold the Sheraton Grand Mirage Resort on the Gold Coast for about $192 million. It hopes the Treasury assets will earn a bit more.
Now, the big economic news over the past 24 hours has been interest rates, of course, but there was also data out on building approvals, and there's some good news for the construction sector.
And that sector needs some positive affirmation. The number of new dwellings approved rose by 7% in August, following a big drop in July, according to the Australian Bureau of Statistics. Approvals were particularly strong in Victoria and pretty good in New South Wales and Western Australia. These numbers bounce around a bit. One big number can shift the data, but it looks like approvals, which have been declining for 2 years, are starting to flatten out. And before we leave the Bureau, figures released yesterday show that the number of new owner-occupier loan commitments, basically people taking out a loan for a place they want to live in, rose 2.5% in August. Mind you, they're still down 12% on a year ago.
Now, Sean, we love a good crackdown here at Fear and Greed, and the federal government will spend nearly $40 million on a crackdown on unethical and potentially illegal activity in the vocational education sector.
Crackdown's a funny word. Would you agree?
It actually gets funnier the more times you say it.
Or the more you think about it, down.
It's one of those ones where I'm like, come on, you can say this without laughing.
Yeah.
You're not 14 anymore.
Okay, so let's get back to the crackdown. In essence, the government is targeting training providers who rort the system. The Australian Skills Quality Authority will set up a new unit that will use data matching technology, basically to try and catch bad behaviour. There'll also be a new confidential tip-off line.
Ooh.
Quite the crackdown.
Yeah, that is a good crackdown. Now, an update, Sean, from a story yesterday. This was a remarkable story. The online gaming group Better has asked punters for time to pay out what it owes on the Penrith Panthers win in the Rugby League Grand Final.
Remember, Better's opening offer, which actually commenced in September last year, was 100-1 odds for the Panthers to win this year's NRL contest. The Panthers, of course, had won the previous 2 years. The cost to Better of the team's success over the weekend has been estimated at $40 million. Better isn't speaking, but the gaming group sent messages to winners saying the payout was such a huge hit that to process and settle all the winning and losing bets on these markets will take longer than usual. It's set 5 p.m. on Friday, October 6th as its deadline for payouts.
Oh, so that's only, 2.5 days away.
It will be scrambling, I'm sure.
It certainly will be. Now, finally, Sean, the numbers are all in, and viewership for the AFL and NRL Grand Finals made them the 5th and 7th most watched programs of the year.
And that's unusual because normally they both come in the top 3. Not this year, thanks to the Matildas and the Football World Cup. The top 4 shows in 2023 were Matilda football games, led by the semi-final against England. Number 5 is the AFL Grand Final, which delivered 2.5 million Metro viewers for 7 on Saturday. Number 6 is the first Rugby League State of Origin match this year. Number 7 is the NRL Grand Final with 1.85 million Metro viewers. I got some help from Umbrella for these numbers. What they really show in free-to-air land, sport is still king.
Yeah, it certainly is. Now, in international news, Sean, shipments of Teslas globally have fallen for the first time in a year on the back of factory struggles.
Tesla shipped 435,000 cars around the world during the September quarter, which was below expectations and more than 9,000 less than the June quarter. Basically, Tesla's preparing its factories to make a refreshed Model 3 sedan and a yet-to-be-released Cybertruck. So I love the name of Cybertruck. Don't you really want to see that? Basically, the company's just reassessing their factories so that they can create those. They still expect to manufacture more than 1.8 million cars this year, though. Still a big business.
Yeah, you can probably say that, Sean. Now, life is never dull for Evergrande, the Chinese property company that nearly collapsed, stopped trading, recommenced trading, and then last week had its CEO carted off by police. Yesterday, its share price surged by more than 40%.
Yes. So late last week, trading in the property group halted after the CEO was taken away by police, according to media reports. The reports speak of suspected crimes, rather vague, really, and renewed uncertainty about the group's debt restructuring. Now, this is the company, of course, that was trading around $1.60 Hong Kong dollars a share when its debt issues emerged. It was suspended for months and months, reopened a couple of months ago. Its share price in a day went from $1.60 to around 30 cents a share. It had recovered somewhat. And then the news about its CEO. That was Thursday, suspended again. Yesterday, reopened, up 40%. Who knows?
That's that. You know what? That company has like all the makings of a movie, don't you think?
No, totally. Yeah, you're right.
Oh, it's got the drama. It's got the intrigue. It's got
the individuals.
Yeah, the geopolitics of it all. Like, it's just, sign me up.
Absolutely.
Now, up next is the Fear and Greed daily interview. Matthew Kidman from Centennial Asset Management is your guest.
Yes, all about whether or not there are opportunities in the market given the sell-off in recent times.
Yeah, it's coming up next in the Fear and Greed playlist on your podcast platform or at fearandgreed.com.au. And, of course, Sean, I know you've missed this because you've been out travelling the world, but every Wednesday is, of course, How Do They Afford That Day? You've got a bit of a backlog to get through.
I do. Well, you're assuming that I haven't been listening as we go, but as it turns out, I haven't. But yes, quite the backlog. What's today's on?
Well, today's episode is actually about micro investing. So, you know, a lot of those apps and things that allow you to kind of invest kind of $1 or kind of round up your purchase to the nearest $5, and then the rest of that kind of gets swept into an account that then gets invested in a particular asset class. And so we kind of get into how all of that works, who it's suited for, but also Canna Campbell, who is the financial planner that co-hosts the podcast with me, has a very, 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 very strong view on this. And she's not a huge fan of micro investing.
Interesting.
Yeah, it is interesting. And I'll put a link in today's show notes so that you can check that one out. Thank you very much, Sean.
Thank you, Michael.
It is Wednesday, the 4th of October, 2023. Make sure you're following the podcast and join us online on LinkedIn, Instagram, X, and Facebook. I'm Michael Thompson, and that was Fear and Greed Business News. Have a great day.